So the new tax law that was enacted in 2017 has this major new provision that is called a 20% pass-through deduction. It's a very controversial provision, and it's also misleadingly called. First of all, it's not just for pass-throughs. Individual business owners can take advantage of it. Second of all, it's not really a deduction either. So when we think about deductions, it's, oh, you give something to charity, so you can deduct it. You pay mortgage interest, you can deduct it. There must be some kind of payment in order for there to be a deduction. But for this deduction, no payment is necessary. So it is a rate cut. It's a 20% rate cut. So if you think about it this way, the top marginal rate under the new law is 37%. So if you are not eligible for this rate cut, your rate is 37%. If you are eligible for this rate cut, your rate is just under 30%. So it's a significant rate cut. It's not good policy. It randomly or for no good reason creates sort of winners and losers. It has significant revenue costs. It's going to lead to a lot of tax planning, a new kind of tax planning, and it has bad distributional consequences. So I really struggle to say anything good about this new provision. So starting with kind of random winners and losers, or not so random, I'll just give you two examples. Architects are eligible for this rate cut, but accountants are not. Why? Who knows? This came out at the last minute, maybe because architects are connected to real estate, and real estate is, a good business to be in these days. I don't know, but the bottom line is, if you're a farmer and you sell to a cooperative, you're eligible for this rate cut. But if you don't sell to a cooperative, you're not eligible for this rate cut. I have no theory of how that came about, but these are the kinds of random, this is just not a good policy for tax law to create winners and losers, to give better tax deal to some kind of taxpayer than the other. It's going to lose a lot of revenue. The reason for its enactment was that the major feature of the new tax law was a corporate rate cut. And so owners of non-corporate businesses were complaining that, well, if you don't give us also a rate cut, we will just incorporate and take advantage of the new low corporate rate. And the answer to this could have been, okay, incorporate, we'll deal with it then. But instead, the answer turned out to be, we'll give you even better deal than if you would get by just incorporating. So yeah, there would have been some revenue losses from now unincorporated businesses incorporating, but now there are going to be even bigger revenue losses because these businesses just get a rate cut to the extent that they do. This is a whole new set of rules that allows for significant tax savings, and people are going to try to take advantage of these rules. Like, how can you blame them? That's what taxpayers do. At the same time, the old kinds of tax planning are going to remain. Some taxpayers are going to be eligible for this rate cut, and so they will try to plan, or almost eligible, and they will try to become fully eligible. Some taxpayers will be ineligible, so they will try to incorporate. So all the problems with these new incorporations and whether these are real corporations or some kind of special corporations that should not take advantage of this new low rate, all of that is going to remain. Plus there's a new kind of tax planning that's going to take place. And finally, distribution. So the fastest growing kind of income, business income in the economy, is pass-through income. Most of income earned by unincorporated businesses is earned in pass-through form. A lot of this income is now eligible for this new 20% rate cut, and it just happens to be true that if you look at tax returns, and economists have, at actual tax returns, so this is zero speculation, the pass-through income is the income that is most concentrated at the very top. So it's true that there are a lot of pass-through businesses that are not particularly owned by wealthy people. There are many of them. But if you look at the income produced by pass-through businesses, it's all in top one, It's almost all in top 1% and even top 0.1%. And it's that income that is now getting a 20% rate cut. So you can easily see what happens to progressivity because of that provision.